at the end of the day, though, as an investor, again here, like when you invest in Aave or, Axelar, etc., you're expecting value to accrue to the thing that you're investing in. You're not expecting value to accrue to two different things. And you're certainly not expecting value to just accrue to one entity, which you don't have any sort of whatever enforceability authority over.
Quick shout out to today's sponsor, Katana. We'll hear more about Katana's 1 billion cat campaign later today, but for now, let's get into the episode. Hey everyone, quick disclaimer before we get into today's episode. Nothing said on Bell Curve is a recommendation to buy or sell securities or tokens. This podcast is for informational purposes only, and the views expressed by anyone on the show are solely our opinions, not financial advice. Our guests and I may hold positions in the companies, funds, or projects discussed. What's up, fellas? Hello, everyone. Welcome back to another episode of Bell Curve. We got me, Myles, and Xavier. How are we doing, everyone?
Doing great. Great to be back. Another good topic.
Another great week to be a token holder in crypto. There's maybe just to use this as a jumping off point for the episode, we're going to be talking about, I think there were 3 big things that inspired the topic of this week's show, which was 1, unification. So this was the proposal. We actually had Hayden and Jesse Walden on the show to talk about this, but 1, there was unification. So it was the combination of the labs and the foundation entities at Uniswap to put one entity. They no longer are charging fees on the front end and moving everything under one roof. And then simultaneously this week, maybe on the less positive front, we had pretty open infighting between Aave Labs and Aave DAO. And we also had an acquisition of Axelar by Circle. And I think when people first read that headline, at least this was my experience, I read that and I thought, that's super interesting. How did they actually do this? Did they buy a bunch of the token to own a controlling stake in the network? And very quickly realized that that is not what happened. They did not acquire any tokens. The foundation wasn't impacted here. They literally just bought out the intellectual property and some employees at the labs team, and token holders got absolutely nothing. And I think people were pretty irate about this. And we were talking a little bit before the show, but I think that the rubber is finally hitting the road on one of the nastiest, thorniest topics in crypto, which is what are tokens and what rights do you get as a token holder? And I think what we want to cover this week, and you guys let me know what parts of this I'm missing, but we want to use these two. I'm going to go just give an overview of what happened this last week, but then use that as a jumping off point to examine why is the structure for crypto protocols so complicated to begin with, right? There's a little bit of a Gensler era reason for some of these structures. Why are we seeing some of this play out? And then what does this ultimately mean for token holders, and how does the industry need to change? I think that's the big one. How does the industry need to change? What is the way forward from here? Because I think everyone is pretty rightly fed up. What else am I missing here?
No, I think that's it. Maybe just like where are we going, and have we actually, solved this problem that, was, or like the root problem of why we're seeing like those headlines this week, I think was a Gensler era like problem, but I don't think we've actually solved it. So maybe we can talk about that towards the end.
Yeah, and I think, Mike, you just tweeted about it just then, but also interesting to take a look at it from an investor versus sort of founder perspective as to, why certain founders might choose to have value accrue to either a token versus an equity, and also what protections investors have, because there's been a little bit of mayhem on the timeline this week with regards to Axelar token holders. So yeah, I think interesting to discuss from that standpoint as well.
Okay. Can we actually start this off? I would love, Myles, can you give us a rundown of what first happened in some tension that initially kicked off in between Mark Zeller and Stani, originally in Lobster DAO, but then spread out all over Twitter? And this is, I think the Aave example is potentially even more interesting than Axelar because it is such a bellwether asset. And simultaneously, it's one that's so difficult for me because I look at that category and I love it. Like borrow lend, stables are moving on chain. Aave has the brand, the liquidity moat, they're the obvious category winners. So many instances when you see a category take off, no one's able to catch them. And yet there's this challenge around the equity business versus the DAO and the token. So what peaked this? And it's very rare, by the way. I've never seen Mark Zeller and Stani go at each other. It's kind of, when you think of Aave, you think of those two guys and you think of them as being aligned. And there's definitely some vitriol that goes out, but I've never seen it internal. So I'm curious. Give us the rundown of what happened here.
So I guess like the context going into all of this is that Aave's been around since, their DeFi 1.0. They really did the like DAO route properly, or at least they tried to do it as properly as they could.
It's really them and Arbitrum that's holding.
Yeah, it doesn't really at Lido. It doesn't really mean it's like easy, but they built the protocol. Then they launched the token, and then the labs team became a service provider to the DAO, right? So the labs team is largely building and operating the protocol in the front end. And they have been for years. They've been getting paid by the foundation or by the DAO to do so. And, there's a bunch of other service providers, but like Aave's not around without Aave Labs, obviously. So there was a revenue stream that was accruing to the DAO from swap fees within the like Aave's like protocol. So I think this was going, they were routing like swaps to Paraswap, which is an older project. And the labs team, I think, like made an upgrade to route swaps to CowSwap. But in making this change, they also changed where the Aave's like share of the swap fee revenue goes, right? So I think it was the run rate of like $10 million per year was going to the DAO from these swap fees. And then, with like just a protocol like update, which didn't necessarily need to have like a change in the economics, it also came with like, that revenue is now going to go to the labs team. And sounds like this was not, I guess, communicated, or like there was misalignment even with it between the foundation and the labs team, which is not like crazy. We've seen that before, but it's not usually like public, if that makes sense. So we get back to the like, this kind of now looks like Uniswap, right? Where they for years had like swap or front end fees going to the labs team, nothing accruing to the foundation or to the DAO, the token. And yeah, I guess I'll pause there. That's kind of like the context.
Yeah. Xav, what do you think?
Yeah, I think something interesting to note in this scenario is that Aave is kind of pulling in a different direction to Uniswap that you mentioned before, Mike. So Uniswap had the two separate entities. There was a lot of controversy there for a long period of time. And finally, with some regulatory oversight, you can see this path to the unification, whereby, all value is accruing to the same thing. And you mentioned it in your tweet before, Mike, but, for employees or having a Uniswap Foundation and a Uniswap Labs, they're kind of two different teams, maybe incentivized in different ways, and therefore, like, are they actually aligned towards the same goals? And I think Uniswap now has done actually a great job with this unification, and we were talking before the show as well at like just how hard that is to actually enact. Yeah. On the flip side, as Myles was just mentioning, you have the opposite with Aave now, where for so long value has accrued to the token. Pre-regulation, there was always a question of governance tokens in general in crypto, of like, what is a governance token? Okay, you have rights over the treasury maybe, but like, do you actually have any authority over the protocol? Whereas like right now, finally, it feels like, okay, value can actually accrue. You can actually enforce some of these things as token holders, but at the same time that regulations are pushing forward, the infrastructure is now more ready. And so apps are being built on top, which just flips the business model again, in terms of like where value accrues. It's more at the sort of interface layer. And that's like previously and historically being controlled by labs entities. And so maybe some teams like Aave are feeling like, where's their share of the pie? And maybe like they're owed more than what they're getting from just the token alone. So that's the kind of interesting way of looking at it, that both Uniswap and Aave have historically gone in actually opposite directions if you think about it.
Yeah. I think there's so many things going on here, but I think going back as far as when I first got in the industry this was 2017 timeframe when ICOs were happening. People used to commonly say there's no investor protections. And what they meant was there's a couple of things, which was one, there was concern that these things might be securities. And two, you have no protections in the same way that equity holders have explicitly spelled out protections, trade on the New York Stock Exchange. I would argue we've made some amount of progress in terms of how can we launch these things. And the answer is you have a foundation, and the foundation is based out of the Caymans or some other place like that. And you have a labs co, and you have clearly defined firewalls, and you have a Cayman director, and all of these answers for how we can launch these things and have them not be labeled as securities. And we've made zero progress on the second part. But now that the US has cracked the door open and said, maybe you can actually launch these things here in some sort of compliant way, the rubber is hitting the road. We've also had 10 years of shenanigans in between now and then, and I think people are just frankly sick of a lot of this. And there are very real infrastructure, legal, and regulatory reasons why a lot of these entities are set up in the way that they are. Uniswap and Aave are great examples of both of this, where they just existed during the Gensler era. And one reason why these entities were set up in the way that they were with the foundation and lab separate is you don't want to get sued and put in jail. And I would never in a million years hold any of these founders. I wouldn't have done anything differently. So, but the other reason, I think but the other reason is actually there were just logistical reasons. For instance, a huge reason that has only recently gotten solved with things like the Duna, which didn't exist a couple of years ago, is you actually couldn't, as a DAO, legally contract vendors, things like that, right? There were very real, just logistical challenges. So to me, that is why, when you look at something like the front end website of Aave, why is that owned by Aave Labs? A bunch of reasons, but I think very charitably, you can just say, based on all of the different reasons out there that exist, it just made sense at the time. We need to be able to interface with vendors and contractors, all of this type of stuff. Now the game on the field has changed, and I just have so much empathy for these founders like Hayden and Stani to go back and undo all of that work is just an enormous amount of work. You're combining multiple organizations. You're uprooting everyone's mental framework. Frankly, it's just a lot of work that needs to happen. And we just haven't let that entirely play out yet. And I think that there's just gonna be some time. And frankly, I think some of these companies, it's really interesting to look at the Aaves and the Uniswaps of the world, where I'm curious to get your guys' take on this purely from an investing standpoint. There's an investing and then an operational standpoint. But from an investing standpoint, my mental model is when you see a new category emerge and someone clearly wins the brand, I mean, you almost never see that group get unseated. But at the same time, it seems like there are real structural disadvantages. Stani's in a really difficult place, right? Where there's just a huge amount of very unpleasant work that is needed to restructure Aave here. And at the same time, what you get for all of that unstructuring is ceding a lot of control to the DAO, which I don't know that I would love to do, right? I mean, that's also a really challenging proposition. So I don't know. It's a really tough problem. But I have a lot of empathy for anyone who's in this situation.
No, I do too. Yeah, I think like there's pretty distinct like phases and types of organizations in our space right now. You have like the Gensler era projects, and that is what we're talking about with like Aave, Lido, Uniswap, all of these guys that had to jump through insane amounts of hoops. And also like this applies to basically like all of Cosmos. I would say like Solana projects for the most part tried to kind of avoid this stuff, but there were, most ecosystems like did feel the need to lean into this. And as somebody who was like a DAO service provider in my past life, it was awful. Like trying to run, a startup and a fast growing, industry in that setting was impossible. You're doing like B2B, negotiations in public with, a bunch of very loud
Myles, I remember this.
token
I
holders.
had so much sympathy for you on these calls. With
Oh
some,
my God.
you don't want to name any names, but I vividly remember,
No, but yeah, I mean, like, so here's the thing. at Reverie, we ran like growth programs, and we did strategy and BD work for protocols because they felt that they couldn't do this unilaterally from the labs org, right? They also had massive, like a lot of capital in the foundation, in the DAO that they could put to work there. And like legally they had to, they felt the need to outsource this, or at least have parallel tracks of like a DAO, doing it while they do other stuff. And yeah, I can tell you that it was not helpful for any of those projects. Like, not saying like we weren't helpful, but like this whole, structure and the way that things had to operate. And then having like, sometimes there'd be foundation teams that weren't allowed to talk to the labs teams. Like they have to have like, firewalled Slacks and things like that. It's like, we are just setting up, we have like a hard mission already, which is to create like a new category of applications and scale them like, to the world, and make them usable and improve them continually over time. And you're just setting up like, an enormous amount of obstacles, right? So that's like one set of considerations for all those projects that are now trying to unfuck themselves in like the Gensler era, right? And then I think for the past year or two, we've been in like a weird like interim era where we know when there's not going to be enforcement. So folks are just saying like, screw it. Like we're not doing the DAO thing. We can have a foundation, but we're not doing this like decentralized, governance thing, which often looks like decentralization theater. We're just going to kind of play this out. Right. And like, I would put like, pump.fun in this category, whereas like, we just ran, the product like a normal company, scaled it super successfully. We're dropping the token, and now they're, kind of have like a weird split there. And then, I think everybody's expecting there to be like a phase 3 after the Clarity Act, which is like, you are either going to be a token and it has like, that is one animal, or you're going to be a security and you got to play by the rules. Right. But I feel I have a lot of sympathy for founders in the Gensler era. Obviously that was awful. I think I have sympathy for, builders today, because it's just kind of unclear. Like you have A16Z, put out a great piece a while ago of like, the foundation era should end. Like here are all these like non-logical things that, if we were starting from scratch today, why these don't make sense. And yet we're not at the point of like, like we're not so sure of that fact that like projects today are not still launching the foundations. And we don't have, I think investors, like to put that hat on, are kind of like, well, is there a bear case for tokens where they're valued, not 1-to-1 with equity, because they are like lower on this cap stack, right? And they don't have these rights, and they never will. And I don't think we can make that call yet, like until we have a sense of what we're working with. And if we overshoot and we get a new administration, who knows if they like try to walk back any like, really helpful progress we've made. Like it's really hard to operate. So I'll pause there because I've been rambling for a bit. But yeah, what do you guys think?
I think that is the key debate. There is, are tokens just equity? And do we need to rewrite some of those laws or rethink some of how we've evaluated that in the United States? Or are these separate instruments at different parts of the capital stack? I think an enormous amount. There is frankly just not agreement in the industry. Even for me, I'm not actually sure where I fall. Here's where I do fall. There is an investor way of looking at this, and there is a founder and operator perspective. And one of the things that equity does in a company is it creates clarity and unity where there might otherwise be misaligned incentives. So like as you grow and scale a company, you have different functions that have healthy tension in between them. So sales and marketing are typically an area where this shows up, and sales goals require, as you get large North Star goals that become dependent on multiple stakeholders, there's a question of division of resources and labor. Hey, if I agree to this sales number, I'm going to need this help from my marketer. The marketer thinks, okay, well, if I help you, everyone's very, politically, selfishly motivated when it comes down to it. If I help you with these resources, then I'm not going to be able to do my own work and get you X, Y, and Z. Product and engineering are another classic area where this tension exists. The way that at a high level you bridge that gap is equity. Equity doesn't give a shit how the resources are allocated. It only makes sense that the most important outcomes go. So if everyone's properly incentivized, what it should do is unite everyone in the same in the same goal, even if you have different, if you're selecting with different parts. Having two instruments not only does not accomplish that, but I would imagine that makes it even more divisive and crazy if everyone is working towards different, explicitly different goals. So not only it's like, hey, if I give you this amount of my time and my team's resources, not only are we not working towards the same thing, but it means your thing will go up and my thing will go down. That is, so it's just, no matter how we spin this, I just can't see a future where businesses have multiple instruments. It doesn't make any sense. It flies in the face of every lesson that I've learned over the 8 years of building Blockworks. I will say, can I also, sorry, Xavier, you're going to, I have one little bit of hypocrisy I would actually like to point out from the investor side here as well, because I see a lot of investors out there who I'm generally very sympathetic to, saying this is another example of token holders getting screwed. I would like to point out something similar that Aave Labs has found itself in hot water a couple of times this year for what I would say are token holder violations. And there was a controversy back in August this year around something called Horizon. So Horizon was a product that was founded. There's a grant that was given by the DAO to Aave Labs to create an RWA initiative. And there was talk for a little while that a second token was going to get launched. And something like 15% of that was going to go to the DAO. And there was an uproar, right? I mean, it was, to me, it's a similar egregious level of token holder violation. I mean, it just confuses the narrative. But what it does, you know what? For all the investors that I hear protesting this today, I did not hear this back then from many investors. And I think the reason for this, and I think the reason why at sign off of a lot of businesses, there's an equity and a token holder grant, and why that hasn't gotten scrutinized to the degree that I think it should have is, hey, I get two of these things and I can dump one of them, right? One of these things is going to be worth something. I can dump one of them. That I'm being a little uncharitable, but I think that's largely the logic from the investor perspective. And so I don't think you can have it both ways. And I know there's complexity here. Some people only operate at the later part of the capital stack and they're only liquids, and some of the early guy. But this should have been scrutinized far more than it has been. And these chickens are just coming home to roost. So to me, there's a little bit of, first of all, just to call a spade, naughty from Aave. This has not been a great year from a token holder perspective. And you got it. Mark Zeller is a colorful character, but you got to give him credit. He's been, calling out some of these. He's been a fierce defender of the DAO, which is its own interesting entity. But yeah, I don't know. I just wanted to point that out because we're talking out of both sides of our mouth a little bit here as an industry. So, Xavier, sorry, I just rambled there.
No. Yeah, great points by both of you there. I think in general, one thing we also haven't mentioned is, there's a very big player in market right now, which I heard actually at Digital Asset Summit at some stage, and I think I mentioned it on a previous podcast, that actually never gave out equity to early employees, and now they're kind of floating a token, and they're using kind of the token to incentivize people now who are joining. And then the question there is, like, I think you were tying back into what you were saying before, Mike, is, okay, like, you're a joiner at X company, and these people who are super early have a bunch of equity, and that's valued like really healthily right now. What is the token going to be valued? And you're kind of putting in your effort and your resources towards accruing value to the token, whatever that may be. And like, probably these days, the way that we've seen tokens versus equity is that value does accrue at different instruments. Going back to the Aave example, you have labs, for example, accruing value at the front end, which is, to some extent, makes a lot of sense for that team, of course. But if you think about it, they have the know-how to build that front end. So of course they're going to accrue the most amount of value there, and they're going to end up extracting value from the protocol itself. And this actually ties back into our previous podcast around, product versus platform and where does value accrue in general, where I think like at the interface layer, of course, like these apps, they're going to charge extra fees. And I think in general, another thing that's happened this year, which is also topical, is you've seen the first breakout apps in crypto, which don't need a token to actually work and generate revenue. And I think like Polymarket is a great example here where, okay, the product works, it's generating revenue, and they might not even need a token. Are they going to launch a token? Like, speculating here, but one might guess they probably will. Is it needed? Like, not actually sure. Is value going to accrue to the equity of the token? Again, not actually sure. But I think from the investor perspective, like Mike, you were saying before, from your founder perspective, from an investor's perspective, typically these days what we'll see is like, equity and token warrant. And what that means, like you were alluding to before, is they have the option to there's a lot of trust in the founders. So putting it back on the founder here, like as an investor, I'm trusting the founders a lot. Like sometimes I speak with founders and they have like a goal and there's a main token. And then, especially in the last 12 months, by the way, and it's something else extra to think about, internet capital markets as a thesis has popped up, and all of a sudden people just want to launch tokens like here, there, and everywhere. And so it's like, and there's quite a lot of platforms, really, their business model is based on launching tokens. So they'll approach some founders that we work with and say, hey, launch a token. And they're like, oh, okay, this is actually an interesting proposition. Like maybe I'll launch this token. And then the question there is like, what are you actually launching the token for? And like, is it like a meme coin? Are the rights to that coin? Is that the same token that, we might have invested in at the start? And then on the flip side, like I, alluding to as well, is that maybe there's the token warrant, but ultimately these days with mergers and acquisitions, which we also haven't touched on yet, like mergers and acquisitions in itself is also a growing category in crypto, and they're not acquiring tokens. Like I have a good friend of mine, shout out to the guys at Areta. They did some really early work into like sort of crypto M&A like over the years, but now the M&A space is institutionalizing and maturing. What you're seeing at the moment is that they're actually acquiring the equity. They're not acquiring the token. And what I'm seeing now when speaking with founders is they're much more aware of this, of like, hey, they're going to look at potentially the equity. If we want to sell into Stripe or someone like that, we need to also make sure that some value is accruing to the equity. And I think this is and just to like finish here, Stripe is somewhat, or whatever, these kinds of incumbents are somewhat a corporate here. Why? Because founders that maybe are building a network in the past would have had just a token. They'd put all the effort into the token. These days, they put quite a bit of effort into the equity as well, because who knows, at some point in time, maybe they're generating enough revenue serving that network. And we've spoken about Patrick from Commonwear. Commonwear's whole kind of business model was around serving the networks that it built itself. And that's very valuable for the equity of Commonwear itself. And so you have this chain of thought around, okay, great, like equity can accrue if you serve a certain network, for example. On the flip side, though, where you're also having, and we spoke about this earlier in the show, also the incumbents are somewhat corporates here, is that Stripe or, whoever else, there's Tempo, etc., Circle Arc, like they're kind of issuing coins or tokens, let's say, but they also have equity value. And then the question that we will have right now is that we don't actually know the tokens themselves. Are they going to have tokens? Are they going to be rights to these tokens? Are they going to have cash flows? I think a huge gap in the market right now is like just transparency across on-chain and off-chain revenues. Like it would be super cool if someone like Stripe came out with like some technology which allowed a holder of the token to verify what was accruing to the token on-chain versus what was accruing to the equity off-chain. And I think you can potentially have both if you can verify where value accrues and it's transparent and there are standards. But right now, there's absolutely nothing there for anything at all. So like, I think we're in a tricky place right now where it's a bit of a who knows what the hell is going on.
This episode is sponsored by Katana. Katana is a DeFi first chain built for deep liquidity and real yield by redirecting chain revenue back to active DeFi users. The 1 billion KAT campaign is live. Bridge and deposit directly into vaults in one simple click and start earning immediately on your Ether, Bitcoin, USDC, and more. Follow the link in today's show notes to get started. As always, investments in blockchain technology involve risk, terms, and conditions apply. Do your own research.
Can I like lay out a maybe like a formula of like the perfect world? I don't know, combination of like components. Well, I think if you were starting a company right now, like you wanted to be like a Web3 application, let's just make it easy. Like there's like some consensus things that everybody wants, and we're not sure if we can have. Like, I think having no token until you hit PMF is really nice, right? I think that's like, I don't think there's a ton of debate about that. And then everything shifts or converts to the token post TGE, right? So this is like value accrual, IP ownership. So that's like, okay, great. But we want to do this like without the operational trade-offs, without the decentralization theater that you have to then partake in once you have launched a token, right? You just want to operate this project like a normal equity project, even post token. And at the same time, we also don't want the burden of like the token being a security, right? You don't want to have to KYC gate, investors buying the token. You want to be able to use, the token for things like token incentives that can, be programmatic and go to anywhere, to anybody in the world if they do useful work or do have whatever you want to incentivize, right? And so I don't know if I don't know if the clarity is actually going to give us this perfect world recipe of things we want, right? It would have to be some, admission that, yeah, these things we're going to let them be securities, but we're not going to, impose security regulations on them. Paying taxes, right? The token, for revenue, doesn't at the moment pay taxes. And where would they pay taxes? Is it a single jurisdiction? How do you handle this stuff, right? And so this is seems like a trilemma, right? I don't think you can have all three of having everything oriented around the token and dissolving the equity, retaining the equity control in operations and value, classic value accrual methods, right? But also not having to follow securities laws. So I think, the bear case for tokens, I guess, is if people if you either have to, they become less fun because you have to follow securities laws, or they become less valuable than equity, explicitly, because they are, even further down the stack, the cap stack with less rights. And that might come when Coinbase launches a token, right? Or when companies very large established companies launch tokens, because then they'll have to explicitly address that, what this thing is.
Can I actually, though, even address, it's not even super obvious to me. I know, given what just happened these last couple of weeks, this is going to be a very unpopular thing to say. I don't think it's a foregone conclusion that if you were to have tokens exist as a part of the capital structure that's subordinate to equity, it's not clear to me that would actually be smaller than equity if you got enough liquidity. And I would just say, it's not like equity, you wouldn't have, we're making these almost value judgments, equity is subordinate to bonds. Does that mean equity is worth less than bonds? No, it's just a different thing. And actually, should have been invested in equities, not bonds, the last, although it's been a good 40 years for basically everything. But anyway, I do think there's a question there. But to your broader point, I think a lot of it hinges on whether or not we are willing to change in the United States the version, how we think of equities. I would say that we just can't surrender, though, on, I think we're at the place where the rubber's met the road, and you cannot, that second bullet of having to operate in a cohesive structure, it is impossible to compete in the way that these things have structurally been set up for the last 10 years. Exactly. I can't point to a single instance of it actually working, because, and honestly, there's a strong correlation in between the companies that were able to find workarounds, to this and still essentially get that equity control within the bounds of legality. I mean, those are the companies that worked. But in the way that we used to think of this as an industry, the mental model on paper, I think it's broken. One other point in this trilemma that I would like to point out as a mental model that I think needs to break is, I think that it's time that we acknowledge there is a difference. This goes back to our platform. I think a lot of companies in this space want to be a platform, right? And so the mental model that actually does kind of make sense for L1s is there's a foundation that, is in charge of this platform, but then there is a lab. I mean, this is interesting in between Ethereum and Solana. There's a labs entity for Solana, but there is none for Ethereum. But there is such a diverse range of contributors and people that are building on, for instance, Ethereum, that I think they have achieved this platform-like scale. And I think people tried to borrow that mental model for Uniswap and Aave, and I'm not picking on anyone here. This was the mental model the whole industry had, is, we're not the sole contributor. We're going to get Uni, the protocol, to a point where we're just a contributor. And it's guys, come on. That is so clearly not what's happening here. Who is competing as the other dev shop opposite Uniswap Labs or Aave Labs? Come on. Or Board Ghost or whatever they're called. I'm going to stop using specific names because I really do not want to pick on Uniswap and Aave here. But I just think that mental model doesn't make any sense anymore. And again, this is the market telling you what is a true platform versus what is a company with a product. And there's nothing wrong with a company with a product. But I think that that's also part of something that's getting mixed up in here, is a broken mental model of there's the platform and the foundation, and then I'm just the labs entity and I'm just providing a service. And I think we need to update that mental model because it doesn't make any sense anymore.
I mean, I don't think anyone ever thought it made sense, to be clear. It was just like, if you want to launch a token, here are the trade-offs of doing so. And most people are like, yeah, that's worth it. Because, I mean, we're not going to not launch a token. And others were like, no, we're not going to do that. Polymarket, great example, right? And so I think the set of trade-offs are now a little bit more unclear. And that's kind of my point.
That's a very good point. That's a very good point.
I think as well, you made an earlier point, Mike, I think around like sort of Aave as a brand and like how that has established itself now as this category winner. It'll be interesting to see how the market responds. I mean, at the end of the day, like we're going to see if a response occurs. And yeah, I actually read a post just before I hopped on here around like, I'm pretty sure the Aave DAO governance is already sort of proposing some things to accrue all value to the DAO, like as of like as soon as possible. And I guess there's some conflict there between like Aave, the entity, versus Aave DAO. And, you know, I think we spoke about it in a previous podcast as well, but Morpho versus Aave here, again, I think becomes interesting because what you're probably going to end up seeing is some teams flirt with accruing more value to their equity, and it is a temptation. And I was going to mention before as well, like think about yourself, Mike, with Blockworks, and of course, you know, myself at Chorus One in the past. Like you have these companies that are, you know, proper equity companies that have always had the option to launch a token. And then the question there is like, it's again, trust in the founders themselves. Like, you know, like as an equity company, should you do this in the first place? Like, well, as someone like Blockworks or Chorus One, like there's always that temptation, but probably ultimately it's always best not to do that. With Aave, etc., and some of these other newer examples, the temptation is that they're already a DAO, but the temptation is to go like the other way around and go more to the equity and try and accrue value there. So ultimately, it's always like an incentive thing. They want to accrue as much value as possible. And I do think there is something to be said about the centralization of crypto that's happening these days, where like we accept socially that some of these things are centralizing, including where value accrues and maybe teams deserve more capital. The Axelar example we gave earlier, you know, of course, Circle acquired the core Axelar team, and it's now being maintained by another core contributor that is a lot less well known. And then I guess you know, if someone took them to court, they'll say, well, it's an open source protocol. We have other contributors, but we're just a core team. And, you know, at the end of the day, though, as an investor, again, here, like when you invest in Aave or, you know, Axelar, etc., you're expecting value to accrue to the thing that you're investing in. You're not expecting value to accrue to two different things. And you're certainly not expecting value to just accrue to one entity, which you don't have any sort of like, you know, whatever enforceability authority over. So I do think right now we are at a very, very interesting time, especially when it comes to public markets, where if some of these bigger protocols like an Aave or Axelar, and you're seeing it with Axelar right now, by the way, like if the Axelar token is dumping, there's a question there in the first place of like, do they have a great business? Like probably not. So is it fair that they're being acqui-hired? They're not really being acquired as more acqui-hired. Okay, fair enough. They're all like good examples. But I do think right now that like it's also an opportunity for some protocols which get it right and actually wait to see what their competitors do. And then maybe someone like a Morpho, someone like that can understand that, okay, like the Aave token is tanking because, you know, value is accruing to the equity. Maybe Aave's end goal is to be acquired by some major fintech company. Why don't we have a lot of value accrued to the DAO and like push forward like that? So yeah, that's a nice chart you have right there, Mike.
Yeah. So I mean, first of all, it only gets worse, but and I'm not trying to again pick on anyone. No one's chart in crypto looks particularly good these days, but I would love to shift to talking about Axelar a little bit here, because I think this was the straw that broke the camel's back for a lot of people. And, you know, to your point, Zav, one thing that tokens have not gotten public or punished in public markets for this type of behavior in the past. They just haven't. But I wonder, it felt, it's probably too optimistic to call this a potential changing point, but so basically Interop Labs, which is the, you know, the lab co that is the developer for Axelar, the network, they got acquired this week by Circle. And so the headline was something to the effect of Circle buys Axelar. And that seemed exciting. And I'm showing this chart because what you probably saw was a little bit of I don't want to call it insider trading, but the price moved up before the announcement. So I think some people, that's certainly what it looks like. I have no insider knowledge here, but you never love to see that in markets. But anyway, yeah, so that was the headline. And then as soon as people dug into what did Circle actually buy, what they bought was the Interop Labs engineering team. So essentially the key talent, and then proprietary non-open source intellectual property, which was developed by Interop Labs, right? So this was, it seems like what this was based. It seems like, to summarize, is it's an acqui-hire for both ARC, which is the layer 1 blockchain that Circle's developing, and then the CCTP, the bridge for seamless multi-chain USDC transfers. So yeah, that what was explicitly excluded, and I think this is what was frustrating, is there was no that the Circle's announcement clearly stated that the Axelar network, foundation, and AXL token are not part of the deal. So a separate entity, Common Prefix, is going to step in to lead many of the former development activities for the Axelar ecosystem post closing. So it is a little bit unprecedented, right? You would
is it though? Like, didn't Tensor get acquired like a month ago or something like that? And like, maybe the nuance here is I don't think token holders are up at arms thinking that they've like been cheated out of a massive outcome, like big, like they get a bunch of money from this acquisition, because they wouldn't. Like, it's an acquire. Like, they should be getting pennies on the the dollar, which equity holders are as well. But we are seeing it more and more, and like there was just like no communication whatsoever from the team to token holders that is in any way like throwing them a bone of some kind. Tensor was
a comms piece here that got dropped.
Yeah, rough. Well, I don't. What are you gonna say? Also, like there is a kind of like, to be fair, like, yeah, guys, like we can do this. This is the best move for us. Like, and we're doing it. So because it's not
all you can do, and then take your medicine, because there are people that bet on you, right? Yeah.
No, it would be a governance vote if the the DAO owned, or like the ownership of the IP and was over there maybe. But yeah, I mean the Tensor one, I feel like that project was wasn't also like a rocket ship in terms of its fundamentals, but it was doing pretty well. Like, I think people were fairly bullish on Tensor, and now like that's gone. So it's just one of those things that's probably going to be like factored into valuation decisions, for liquid investors in general. Like, especially if you were to, we're going to have like mutual funds ideally holding tokens at some point. And if you're looking at buying a token and you're looking at the exact same product that's, a standard equity company, and you can invest in both, like, fundamentals are 1-to-1, but valuation won't be, right? And so that's not ideal. But we could, I don't know. It's not right or wrong necessarily right now.
I think it kind of hurts the prospects of token premiums in future if you have teams that all of a sudden accrue value to a different entity. Well, who's going to have any confidence in investing in tokens? And you think about us already moving into a bear market. Well, I don't think this is going to help anyone's case, where you have tokens that we need more buyers on liquid markets right now. We need them investing in fundamentals, and if they can't build conviction in a team and a token, I think in general, again, takes me back to my point earlier. Like, I'm sure a lot of investors want this, like, actual rules, or not just regulation, but actually on-chain, proper protocols in place where you can verify what's actually happening and where cash flows are going. And obviously we're a long way to get right now in crypto. Another point I was going to make a bit earlier is, in crypto, because these things don't really ever go to zero, like the token is always kind of like, you never really know, like, everyone's got hopium where they think the token's coming back, and that's probably the same for like the 10 million tokens that exist these days. But like, realistically, a lot of tokens that are trending down probably never come back, like, if you think about it. And so, like, I think token holders themselves, like, if you're holding an asset and they get acqui-hired, for example, I think the belief and the hopium is like, oh, like, it was like 1 or 2 billion at some point in time, now it might be like 200 million, 100 million, but they still believe they can reach that all-time high. And like, I think some of that, again, maybe comes down to communication of like, teams these days, they have these tokens, they pump, and then when the token price is going down, it's not like in equity where they have like great PR and on the phone with all their investors all the time saying what's happening. Like it's kind of unclear a lot of the time what's actually happening internally, and like is there actually value that they're generating, and like what are the growth plans and all of that. Like it's unclear. So I just think in general, like many teams probably look like they might be coming back, but they could be already dead on arrival. And so like as a token holder, again, it's like, can you really judge some of these teams when they're being acquired and or acqui-hired? Like when a lot of the time you don't really know the full side of the story. I don't know.
No, I would never judge teams for being acqui-hired. And it's rough out there. Starting businesses is tough, and you owe it to yourself and your team. If you're in a situation where your enterprise is failing, get acqui-hired. Absolutely. I think what people are, the heuristic that people are objecting to is generally in an acqui-hire situation that would like, no one faults you, but investors get whatever funds are left over, right? It's kind of like, okay, I'm going to take a wash on this, but it's fair. Everyone takes a wash, and okay, God be with you. Do the thing that's right for you, and we'll fund you on the next one. Or that was whatever. It was what it was. But that's not what's happening. It's because there are two separate groups which are getting reward. I saw Hasib arguing about this on Twitter. He's like, we didn't make any money on this. It's like, yeah, but you probably didn't lose as much money either. And I think there's the rub. The fact that you have two will always mean, it's good. And you can't, I think the takeaway from this conversation is you can't have it both ways. You can either have it be a subordinate part of the equity of the capital structure, in which case this can happen, but then tokens don't deserve premiums. Or you can collapse it into the same thing. But Myles, to your point, you have to play by more of the rules. Could I present a potential door number 3, where this for me would be the happy case, where I think that crypto in many ways predicts the future, in the same way that the early internet, like Tor networks where you could just download anything, predicted Spotify. It was telling you something, right? You might have looked at LimeWire and things like that. You could have looked at that and been like, oh, this was a flash in the pan, but it wasn't. It was telling you something about the way that the future was going to happen. And crypto has already done that with so many things. Trading 24/7, right? That was only in crypto, and now that's becoming standard practice for the NASDAQ, right? Like US equity exchanges. And there's a million little examples like this. And I think what crypto has told us is that we need to reevaluate equities laws in the US. And I get that no one wants to do that, and that's a huge can of worms, but that's what it's telling you, I think. And that is to me the true thing that's being told about the future. And the other data point that I would give you here is that public markets are not functioning well. I think that it's a huge problem that companies want to stay private for as long as they do. It is concentrating wealth in the hands of so few people. Think about who has made money on OpenAI stock. There's no other way. It's a tragedy. It's exacerbating so many societal problems that, that 300 VCs get this instead of, when Dell went public, they went public at $150 million market cap. I mean, think about the wealth creation that is shared there, and that is not happening. And, I think about this whenever I hear people say, well, it works. Private markets work. No, they don't. They will. I think it's a huge problem with society. We need to look at this problem another way and say, how can we encourage asset issuers to want to go public sooner? And the answer to that should be, from my standpoint, is you lower the barrier to entry for the disclosures that you have to make. And that's where crypto's awesome, because unlike regular off-chain businesses where this data that investors need is siloed off in individual invoices, everything is public on chain. So what the superpower of building on-chain business, somewhat, there's work. There's work that needs to be surfaced, but I think that we need to reevaluate the disclosure requirements for crypto-based businesses if you put your entire business on chain and disclose everything. That to me, that's the answer, right? Better disclosures equals less regulation. And then you put the onus back on the investor. If the information is there and you make a dumb choice, that's on you. But you should be able to, if you're disclosing more, be regulated less. And I think we need to reevaluate that. To me, in the best case, maybe there are lawyers out there who are listening to this, but that would be for me the best case for regulation, is not to create this dual structure. I think we need equities light, and I think we need to. That's what I would do.
Yeah, it's funny because we've been dealing with our problems in our little bubble for the past like 3 to 5 years. And they're very like crypto centric problems. And then I think, to your point, Mike, like the biggest tailwind that we potentially have to like actually, because the crypto native problem is not big enough to change equity, regulation in the United States. Like what could actually change equities regulation is this problem that I think everybody sees, whether you're in crypto or not, which is like, builders have zero incentive to go public, and the IPO market is totally broken, right? And I've talked to a bunch of folks that have worked on like, some of the earliest like direct listings, like Spotify's direct listing, and just kind of, broach them with like, hey, we're thinking about this problem. You've been working on this problem for a long time. We have these things called tokens. We can, basically like look how fast we can raise money from anywhere in the world. These things are clearly better technology. Like, have we found a match here of like, a problem that you guys have been thinking about and what we've been working on already? And you hear Bill Gurley kind of like, he doesn't.
I was going to say,
I
Bill
don't feel
Gurley's
like
sniffing at this. He's circling. He's so close. I
it's
can hear him.
usually hear it along the lines of like, and I hear like blockchain technology could be the answer to this, and it's like I've been talking to Hester like Purse and like and it's always like, well, maybe yeah, but like I think that's the sort of we need to like piggyback on that
Yeah.
train basically to get enough people like outside of crypto on board that this can actually solve a big problem. And I don't think it's as easy as just like tokenizing privates, right? And selling that to retail, right? Like there's how do we do this without tons of adverse selection and retail tiers? Like it may be not as easy as we think it is, but I do think it's a problem worth working on. And I'm glad there are a lot of teams that have this like dream of fixing the IPO market within crypto itself.
Shout out to today's sponsor, Katana. Katana is a DeFi first chain built for deep liquidity and high yield. No empty emissions, just real yield and sequencer fees routed back to DeFi users. Incubated by Polygon Labs and GSR, Katana is launching with notable ecosystem of primitives, assets, and partners like Morpho, Chainlink, and more. Katana's 1 billion KAT campaign is live. Bridge and deposit directly into Vault in one simple click and start earning immediately on your Ether, Bitcoin, USDC, and more. Follow the link in today's show notes to get started. As always, investments in blockchain technology involve risk, terms, and conditions apply. Do your own research.
I do think like a potential small risk that may occur, but I'm not sure if it necessarily will, is if large corporates, keep feeling like they have the flexibility to launch tokens on chain, and then, like maybe Tempo is the first of many that come in the next 2 or 3 years that we actually don't know. And then if they keep launching these tokens and it's really unclear, like when you buy these tokens, what rights you have, it's different rights for every token. Like these things should be in the billions and billions of dollars, and then retail starts investing, because at the end of the day, they have big brands. They can really come out and say, we have a token, and then all of a sudden retail might buy Tempo over every other token that exists right now in crypto, and they might buy the next corporate token because they really believe, like the Apple token, like they love iPhones, so they're going to buy like the Apple token. It's easier to buy than the Apple stock, for example. And then all of a sudden, retail is at stake here. And I think at that point in time, you mentioned before that crypto might not be big enough as an asset class to actually change equity laws. Well, I feel like if they keep flirting with danger, which we might be the really, really sort of start of this trend. So we actually don't know. So it'd be interesting to see, like, as things progress, what actually ends up happening, and whether standards are clarified or not.
I think that's a very likely relatively near-term catalyst. And it's hard for me to I don't have strong opinions here, but if we saw corporates launch tokens, and there are a couple that maybe you could think Tempo would be a super interesting one.
Base has already said they're like doing this. Inc. has already said that they're doing this, right? And that it's going to be, I'm not super excited for that. Because I do think it makes us confront some things we don't want to necessarily like are ready to confront head on about like what these things are and aren't. Because it's not Coinbase equity. It's taking a piece of like a revenue stream from Coinbase and like putting a token on it. And then, if they make $50 to $100 million a year in sequencer fees, then like, the the value of the token on their balance sheet is going to be many, many multiples of that, single revenue line, right? And how the market values the equity of that revenue line. So I don't know.
Well, when are we going to be ready to confront it? That was my question. Why I think that I'm very much in the camp that the longer you wait to confront these issues, arguably it would have been easier to confront this 4 years ago. But now we have multi-hundred million and billion-dollar valuations that depend on answering this question in the correct way. It's only going to get harder the longer you wait. We have the most friendly administration we are probably ever going to have. I'm like, what's going to change? Why will we be ready to do this in 2 years?
No, sorry. I'll correct myself. This is not the way I want to confront it. Like with existing equity companies with public stocks, or like very, very large private companies just launching, like siphoning off a piece of their business and launching a token on it. And usually is going to just like, I don't know. It seems like there's an extraction play here. And I would rather confront it from the bottoms up sort of approach of like companies that, have a token, but just act like equity and value, like accrue value, and companies that like try to break that trilemma and come across like maybe, issues trying to do that, but people will see it's better. So does that make sense?
I think you get both. I agree. In the happy case, it would just be, hey, let's do the right thing here. But the way that I think issues force themselves and get played out at this scale is someone does a bad thing, and then we have to confront why the bad thing happened and then fix the bad thing. And but I do think that you have an opportunity here. I'll call out Uniswap has done the hard thing. They were kind of the poster child of this misaligned incentives, this misalignment, not because they wanted to be, but because that was the game on the field, and the game changed and they're doing the hard thing. And I also saw an announcement from Jito that the foundation, they're bringing the foundation back to the US, and I only read the top line, but I think you'll see companies differentiate themselves, because again, I think that this really purely comes down to the other context for this. Imagine having been a crypto founder for the last 8 years. Most of these people are tired, man. Like there really is a tale of two cities happening in crypto at the moment, where most people are tired and burnt out. And by the way, people are getting their mental models constantly invalidated. That is exhausting work. That's demoralizing. It's exhausting. You're watching your token get pummeled. But the rubber's meeting the road, and this will force the good teams. You have an opportunity to stand out as a really good team here. And the teams that are able to stick it out, be the line, grow into this next phase, that's how you're going to get these massive outcomes that I think people we're finally fixing. We're getting down to the root and fixing this. And
maybe one last point to mention as well there, Mike, which I don't think we discussed much on this podcast so far, but on the other side, you have tokens, like the kind of premier tokens that people enjoy holding. And if you think about what tokens people are like enjoy holding and as success stories in crypto, at least in my opinion, you have things like Pump.Fun, which has like a bunch of buybacks, and you have Hyperliquid, same story, where you have a bunch of buybacks. So they could, like, I think now going back to what we were talking about before, maybe the market, which is already happening to some extent, like a lot of fundamental investors are really rating tokens that buy back their own tokens, and maybe that becomes the standard in crypto, where it's like if you're not buying back your own tokens, and that's its own can of worms, but if you're not buying back your own tokens, maybe that's going to cause some suspicion with regards to like where value is accruing, and if it goes to the equity token, and maybe there's going to be some premium on that in itself. So I do think that on the token side, also there's a lot happening, even just this year, really Hyperliquid and Pump.Fun only came out in the last 6-12 months. So yeah, whether or not people will follow a trend there, like to really try and prove that there is actually value on the token, even if they have an equity by buying back, like I could see that trend continuing as well. And if you don't do that, I think you might be in a little bit of trouble going forward.
I have pretty strong feelings on buybacks, but maybe we should save that for another podcast.
Yeah, it's like a signaling thing, right? Because if nobody knows what's going on,
it's an expensive signal.
Nobody knows how to trust.
It's an expensive way to signal that.
Yeah. You can't just trust the team to reinvest, and it's either buyback or they're blowing the treasury on.
I think it always comes back down to the same thing though, like trust in the team. Like that's what I think about the most here. Yeah, like the team has the power.
Yeah. Oh, totally. Okay, guys. I think, did we solve this problem? the three of us to solve this problem. I don't know. My takeaway is I think we're just at the beginning slog of this, and I think this will take 2 years minimum to solve.
I think more, actually.
yeah,
I'm
more.
going 3 or 4.
Yeah.
Everybody has strong opinions, so it's fun. But yeah, we definitely don't.
Yeah, so tough maybe market for tokens, but I think it's finally the motivation that people need. And I've talked to a bunch of projects that were going to TG and they stopped now. Like there's just no demand. I think finally we're starting to see that we're just I've been very skeptical of this argument, but I think we're legitimately running out of buyers that people want to buy this stuff. And one important dynamic that's changed is I don't think crypto is the fastest horse in the arena of risk assets anymore. And I know a lot of people have made that call, but the reason it was always the riskiest, stupidest, like dumbest. It's the furthest stuff out on the risk curve. But a lot of this stuff has been de-risked. We're not going to ban this stuff anymore. Bitcoin is not a secure, right? Like a lot of the, Bitcoin hasn't been hacked. Check off the existential risks that have plagued this industry, which ironically have informed that fastest horse narrative on the risk spectrum. I don't think we're in that spot anymore. I think we're in the scale up part. And so if you're not just going to go through this cycle of speculation driving gains, you need something else. And I all of the pieces are falling into place, but I agree. I think it's going to take more than 2 years. We're probably looking at something closer to I would bet this moment is 2002 for tech stocks, for crypto. I think we just had there's a lot of deep questioning. There's an ideological bear market, and we have to work our way through a bunch of these the broken frameworks that we've had as an industry for a number of years. People have to do really hard work of restructuring. And I think that'll take 2-3 years, but then I think it's a slow grind up. And I think there will be generational buying ops for the right teams will show who they are as the market consolidates over the next 2 years. Your job will be easier.
Then you have room for growth, I think. Still, that's the optimistic bull case. But yeah, totally agree with you, Mike.
Plenty of room for growth is a hilarious way of thinking about crypto. It's certainly always been that. Okay, guys, I think we got to end it here, but this was a really fun one. And yeah, we'll be back next week.
Awesome. Cheers, Mike.
See you guys.